We've been fortunate to have a very distinguished group of speakers with us this evening from Verde, Foundation Source, Calvert, and TIAA, and Bloomberg.
There are three important points we'd love for you to take away from the evening. The first point really is that sustainability now equals profit, right? More profit than likely the companies and the investments that are not sustainable. The second point that we really love you to take away is now is the time for action. So profit, now it's time for action. And the third point I think is also important, is that we'd like to partner with you to figure out how that works for you personally.
We are all stakeholders in something, and that is Earth, right? We're here for a reason. We are intrinsically connected with the soil, the water, everything that keeps us here. In order to sustain that in generations following, we need to understand investments with a much wider lens. And developing this is increasingly becoming aware with all the asset managers now that are understanding the trend that ESG, environmental, social, and governance factors, must be incorporated into their analysis.
Manage it differently. They're taking a much more holistic approach. They're saying, what can we do better? Can our endowment and the things we are invested in reflect and align with our values, the values of our grant?
Things that we did in 2008 was provide ESG data alongside all the financial tools that we have on the terminal. So all of a sudden, investors can look at the carbon footprint of their portfolio, understand potential risks around water, carbon emissions, safety, corporate governance. So just as investors are already looking at information, they can actually bring that data in to the normal analysis. And I think I think clearly, there's been that takeoff, and we've seen at Bloomberg something like 20,000 regular Bloomberg users are accessing this data now. It's increased basically 50% a year since we first started. And it's moving to, from that niche, from those crazy, hippies in the corner, to actually this is what institutional investors care about. We heard all the examples before, and if you use this additional data, why would you not invest in a more energy efficient company, the company killing fewer workers, potentially less downtime and lawsuits? So we can take that additional data set and actually apply it to the investment case.
Many of our largest international clients really felt that they had a fiduciary responsibility to be investing sustainably and to have an influence on their asset managers, to be integrating environmental and social governance factors into their investment criteria. And prior to that, I was with Smith Barney on the investment advisor research team. So I've sort of seen how this has evolved over time, where it used to be when we would bring in an SRI manager, all of my colleagues on the investment committee would sort of roll their eyes and really believe that there was no way that these types of strategies would ever outperform. So it's been very interesting to see how this has evolved and really come full circle. And I really believe it's not going away. This is going to be the way that investors invest going forward.
Working with TIAA, who is really one of the primary and earliest investors developing socially responsible investing products for their clients, has been just a tremendous experience. And I think we've seen in the last 6 years that I've been there, it grow so much. I primarily work with our institutional clients, I work with some of our retail clients, and I have been busy. It's millennials, it's institutional investors, and I agree with you in that we were just talking before this session that probably down the line, we're all going to be talking ourselves out of our role specializing in this area of investment because it's just going to be synonymous with any kind of investing.
It seemed to be, in France and in certain parts of Europe, there was a bigger, Norway, areas where sustainability was more focused on. Can you tell us a little bit how you view that and, where that's gone and what you think it's going to do here? Are we late to the game? Are we getting there? Or, what do you see?
Yeah, so no doubt, we look at the surveys from EuroSIF and such, you see something like 60% of professionally managed assets in Europe apply a sustainability ESG filter. And if you look at the US, it's only about 30%. So the US is behind. and it's the big pension funds that push it. So in Norway, Norges Bank owns all the money. If you look at Netherlands, the couple pension funds own all the money, and they push it down. And I was actually in Cape Town, South Africa a couple of years ago, and the big pension fund there, they got on board, and all of a sudden, every single asset manager cares about it, right? If the big pot of money cares about something, you care about it. And I think, you're seeing the same thing starting to happen in the US. I think issues like climate change push it along. Oil prices, they go from $100-something to 30 to 50. That's something I can tell when I publish analysis around issues of stranded assets. But what could happen, what has happened to coal, what could happen to oil and gas. When prices were 100 plus, nobody read what I wrote. Prices were 30, everybody read it. Back at 50, rating has tailed off. So there's definitely something going on there.
All right, so Alex, could you tell us a little bit about performance and how that plays in, and you're dealing with some institutional clients. How do they view this now as, part of their investment process, I would hope, and how does it drive performance?
Well, I think in terms of Calvert and how we think about it, so because we've been involved for 40 years, so we have seen this evolve from one-off, pass-fail, or exclusionary investing, which may have not contributed from a performance standpoint. But what we've seen is evolving towards more inclusionary and really recognizing those corporations that are aware of what their impacts are to society and to the environment. And those companies that meet that threshold, we believe when you're looking at and evaluating companies, really thinking about the full set of criteria, both financial and then non-financial, environmental, social, and governance factors, both from an opportunity and a risk perspective, that over the long term, those companies should tend to be more sustainable. So that company management that is aware of what their impacts are on society, the environment, and are putting policies in place are going to have more sustainable businesses over time. They're recognizing it, investors are recognizing it, capital markets are recognizing that, and that's why you see this big momentum. And over time, we do believe that this type of investing should be able to outperform. We've developed passive indices. We have several responsible indexes. And if you look at our large cap core US responsible index relative to the Russell 1000, over almost all periods, we have been able to outperform. And we believe it's because you're recognizing companies that are going to this will translate to the bottom line, and you're also really avoiding risks. So if you think about it from a lens perspective, we feel that we have more transparency. The more data you have, the more that you're aware and thinking about all of the different, every criteria, it's much more transparent and a clearer picture of what you're actually getting from an investment perspective.
Christine, in your role as a client portfolio manager, what do you see corporations trying to do? Do you see them in the C-suite, trying to move in the direction of being more compliant so they can be more included in, in some of this type of investment? Or, what have you seen in that area?
Yeah, so, it really is a matter of everybody moving their investment strategies in this direction. If we look at the 401k space, for example, there are so many more of those companies looking to incorporate these types of investments into their retirement plans, just given the fact that they have a younger workforce. They want to accommodate that millennial request for being able to incorporate environmental, social, and governance criteria into their investments. There have been considerable studies done around employees being more satisfied with their employers, having a greater sense of wanting to stay with their employers when they're satisfied with their retirement plans, and that's going to be part of it. As far as companies are concerned, it's really a matter of, as Alex said, evaluating various risks as it pertains to environmental, social, and governance concerns. So particularly for us, we've noticed with our fixed income portfolio, it's really, fixed income is a little bit different than equities. You're not looking for growth with fixed income.
You said some portfolio.
Our fixed income portfolio. So as far as corporations that we're investing in from that perspective, you can use this ESG criteria to serve as a risk mitigation tool right? Because so many of these things have financial materiality. If you want to invest in the debt of a company, now again, with debt, you're really just loaning money, waiting to get that back plus something extra. So there's really not a huge upside. But really, you want to understand where the risks lie within the business, and you want to understand if there is a company, for example, that has an opportunity to have tremendous impact to the environment, but they're not a good steward of the environment. This is something that's going to be surfaced in this kind of evaluation. So that's where I see companies being more mindful of looking to really report on these things, be mindful of their performance versus their peers with these things. So it's a two-fold answer.
And I would just add that if you think about it, global corporations are evolving in terms of they're responsible for a lot of the problems that exist, whether it's from an environmental perspective or what the impact is on society. So there's really this evolution of corporate responsibility and the changing role of corporations to society and to the environment to fix these problems, and that they have the resources, and the quality managers or those leaders are the ones who recognize this and are doing something about it. And I think investors are also requiring that. They're requiring more transparency, more data. So there really is an evolving role of the corporation to society, and thinking about the material impacts that they have in the communities in which they operate and on the environment in terms of their business operations.
And if I can
Yeah, please.
pick up a tangential point, discussion about millennials and how they're going to invest in the future. One of the things that we're seeing now, even if they don't have a lot of capital to invest, they can buy products. And so, Danone took out White Wave. It's the only growth you see in consumer goods. It's coming from some of these sustainable products like White Wave, which makes alternative to milk. If you look at Ecover that Unilever just took over, so where do you see this growth? You see this sort of value shift happening already at the consumer goods, and I think sort of risk, which is clearly there, but also the opportunity side of it. Cash and investment is starting to move to where the growth is.
Now, you're sitting in a seat, at Bloomberg, right? It's a big place.
Yeah.
You hear
A lot of snacks.
Open environment, very nice, yes. Well, what I'd really like to know is, do you see, look, 80% I've heard of the S&P 500 now are being screened, companies are being screened for, ESG, SRI, this type of investing. Do you see, obviously that growing, or, do you find you getting called by a lot of, portfolio managers, and can you kind of line up, the shift like in Norway, you made that example of the fund having all of the, the ability to help their own country doing sustainable things and this type of thing. What do you see here? Who are the biggest sustainable investors here that are institutional investors? Maybe each of you might want to comment on it.
Yeah, so one of the things that I've definitely seen in the last few years, it shifted from the sort of ESG investment team in the corner to all of a sudden all the portfolio managers have to care at least a little bit about it. And so one of the extreme examples is that Aviva, the insurance company in the UK, so a few years ago they tied 10% of all portfolio managers' bonus to ESG integration. They care about it for some reason after that. And so you don't necessarily see that, but there's been that push. The institutional investors, they care about it. It gets pushed down, and it's not good enough just to simply say, oh, we have this one sustainability fund or product. Sort of across the investment portfolio, different funds. How are you looking at this? So Legal in general, also another insurance company in the UK, a few years ago, they specifically, they were losing mandates. And so they went out and hired ESG person so they can actually full-time integrate across their fund. I was in Japan earlier this year, and one of the big asset managers there, they lost a mandate in Europe. And the only thing they could think of is they said absolutely nothing on ESG criteria. So what have they done? They've gone out and hired a full-time ESG person because they have to be able to respond to it. So I think it's more of, as we said before, evolved in Europe. I think the same thing is starting to happen here for the same reasons.
You guys seen this?
Well, I would just say from an institutional perspective, I think CalSTRS, CalPERS stand out as some of the larger institutional investors that definitely they have their own 21 risk factors. which incorporate environmental, social governance. But then you also think about there are some public plans, teacher retirement, where after Sandy Hook, they don't want ammunition or they don't want tobacco. There are going to be different social screens. But I think my sense has been that everyone's trying to wrap their head around it because it's this acceptance that it is evolving, it's changing. More and more investors are talking about it. It means different things to different, whether foundation, institutions, families, what have you. But it's really to understand what are the options, what do I need to know about it, how can I implement this in my portfolio? Is it going to be a piece or is it going to be the entire portfolio? And I think with a lot of institutions too, if it's an investment committee or a team, people can have very differing views, again, as to what it means or how it should be incorporated into the portfolio. But I think the important thing for everyone in this room is that everyone's talking about it. It's not going away, and the more that we're educated and the more that we're familiar with what the options are and how to think about it, I think the better off that we will all be in terms of serving clients and growing our business.
I mean, teachers' pensions, huge, right? So,
Yeah,
you guys have been involved in this, and
we've been involved since the 70s, and that's absolutely something that,
just like,
yeah, as an organization, we've begun the integration of all of the ESG research that is available that we work with to develop our socially responsible products. That's actually also available to all of our public research partners. We also have a big sustainability initiative on our real estate and our real assets portfolios. So it's something that's always been a very big part of our culture, and I think there's more and more of an acknowledgement that this ESG is actually additive in a lot of ways to performance. It's additional information. It provides an additional lens of being able to evaluate peer companies to see who's doing the best and leading the way forward in their practices. So it's really something I think that we're just really leaders in.
Does anyone have any questions that we haven't covered?
No. Hi. I sit on a foundation board and we try to implement this. And I guess what we're trying to think through is how should we think about this? Is it that we should think about it as like we're like an active strategy and we're like, oh, Calvert's great at that, so we want you to like be our fund manager? Or is it a passive, like because we want to pick some particular play on what we feel like, oh, we only want to be in a passive index fund that's fossil fuel free? Like even if you've got the intention, how do you think about it in your portfolio?
I think you start with your investment objective first. I mean, at the end of the day, these are simply building blocks for a complete portfolio allocation that you're going to have, whether it incorporates these things or not, whether it's conventional or an ESG type strategy. So I think going from there, and a lot of people use active strategies, passive strategies. So I think now there's much more of an opportunity to be able to access taxable core bond that incorporates ESG criteria, whereas in years past you haven't necessarily had all the appropriate building blocks. So I think based on your individual investment approach, you're going to be able to seamlessly incorporate strategies that also incorporate ESG criteria. It's not a separate set of products. They are just products looking to achieve investment performance as any others would.
And I would add that we can screen a portfolio, so we can take your portfolio with Greg's good work, and we can screen a portfolio and say, okay, it's 50% sustainable. The S&P, I believe, is like 65% sustainable right now, if that's right, or is that a little high? Maybe it's like 50%?
Varies on the research.
I think it's like 55.
Well, I think that's one of the points, is there's a million different ways. Not one way you don't turn on the ESG
Right.
switch. Are you worried about carbon? Are you worried about social issues? And so that's one of the, I think, important things when you're investing, to understand what is your objectives and sort of what issues are you worried about.
Right.
And how's it
You did say you could quantify it. So let's say you look at the MSCI, the European index, going back 5 years, and you compare the top sustainable, however you quantified it, to the top quartile, to the bottom quartile. How did they perform? I'd like to know.
Yeah.
Because it's been happening in Europe at 60%, you said. We are, 5 years behind. So if I made the investment now, maybe I'll mirror that. How did it do?
So I think it depends on the index, and sort of your
Well, they take the
strategy.
European, you know, all the, whatever.
I'm not-
You pick a European index, that's.
So yeah, I mean, so one of the things, so the MSCI, so they have their ESG indices, and I think one of the things that you're picking, if you're sort of looking at good sustainability companies, there's a strong correlation between sustainability ranking and market cap, because basically the bigger you are, the more money you have to make pretty sustainability reports. So you're going to have a bias because of that. You know, if you're looking to do something about carbon, you know, if you keep excluding or underweighting fossil fuel companies, you know, so there's all these other factors. That's one of the things that if you move one factor, something else is going to wiggle. So you just have to understand what you're getting into.
But I think, oh, sorry. I was going to say, I think that's a good point, is the availability of data. So obviously, data tends to be more available for your larger cap companies, less so for small cap emerging market equity. So I think in terms of the implementation from an investment objective, it's also understanding what you're getting in the portfolio, because there are also different rankings and ratings, and there's this concept of best in class. Whereas like for Calvert, we're not best in class. We don't hold our nose to own the best of the worst. So there will be certain sub-industries we know that we won't have in our portfolio. That may not be the case for another manager that does use a best in class approach and is willing to own the leaders, you know, relative to their peers. So I think it's really understanding what you're getting, and also the point that data is not as readily available, and some isn't, but it's increasing exponentially every day. And as the data becomes available, much easier, it makes it easier to evaluate companies. It also makes it easier to have this impact reporting around what you're getting from an impact perspective in your portfolio. We agree with your point that there is this element of ESG momentum, so that the companies that are the top performers, that have already gotten it, that have the appropriate policies and procedures and are ahead of the curve, you're not going to see as much upside as to companies that you can identify that may have had a controversy, that now they've put policies and procedures in place, and where there's this momentum factor in terms of the improvement that can be anticipated, and that those companies tend to be really the sweet spot, both in fixed income, bond investing, as well as equities.
And sort of on that point, I mean, so one company, Kaz Minerals, so in Kazakhstan, they mine whatever they mine. They have a horrific fatality rate. We actually see correlation. The more fatalities, the more mining companies donate to the local community. Basically, the more you kill, the more you try to buy people off. And to the point where this company was donating about 7% of revenue to the community, and they've brought their fatality rate down. That's come down to about 2% of revenue. And so one of these things, so if you're getting better, you know, there's ways of trying to save money, obviously, all the kind of related, so, you know, you can play that as well, bad company getting better.
I would say in terms of things like private equity real estate, I think there's a lot of metrics now in place where you can begin to evaluate the carbon footprint of some of those investments in a way that there hadn't been previously. That's something that we have a tremendous amount of investments in at our firm, and we've also made a commitment to reducing the overall carbon footprint. So I think that others are very mindful in the real estate space as well. Same thing is going to be with agriculture, same thing is going to be with timberland. So anything in the private markets arena that has a natural environmental focus, there's going to be likely a commitment to mitigate any detrimental effects to the environment, because you're also trying to protect those assets. So that's something that you probably want to ask about in terms of your private investments.
And that's really where you get the direct impact, is more on the private equity side. And so I think there's definitely, there's a opportunity for that in any portfolio, you know, in terms of thinking about the bigger picture, where you do get direct impact. Calvert has a sister organization, the Calvert Foundation. It does direct impact notes for communities, so such as in Denver, Baltimore, and we do have a small percentage in our funds so that we can provide that direct impact, you know, from what we call special equities and direct community notes. But I would just say that's really, when you hear people talk about impact investing, it's more on the private.
So where that exists, as an investor, I can see it in the perspective that the team can tell me that, okay, there is a piece of that in this portfolio. It's not all public. It's
Yeah, at least with our funds, we do, but it's a very small element, but it's to give investors that direct impact within their portfolio.
I would also say too, we haven't talked a lot about fixed income on the panel, but there is a real opportunity. I mean, in the equity side, you're investing in the equity of the company, you're buying just their general operations. But in the fixed income side, there's actually, even in the public markets, an opportunity to finance a project or to finance the mission of an agency. And that's something that we're very focused on within our fixed income portfolios. We have a special categorization of securities that we've termed proactive social investments. And the idea is that they not only provide return to the portfolio, but there are direct and measurable outcomes that are associated with these investments. So it's going to be financing of wind farms, solar farms, so that's going to be carbon, natural resources, so platinum LEED certified CMBS for buildings that have that LEED certification.
I want to thank our panel speakers. Hopefully got us a much better understanding of this space, ESG, SRI, ESG, and impact